What if I told you that sterling just printed its most deceptive high of the week, and 90% of retail traders are positioned on the wrong side right now? Welcome back to Alpha Market Meridian. I'm your host, and today we are putting cable under microscope. Pound sterling to US dollar. Price is hovering near 1.3580, but a monster rejection at 1.3632 tells a story the news hasn't caught up with yet. Stick with me, because after we cut through the noise, I'll hand you 3 precision trade plans with exact entry zones, invalidation lines, and profit targets that even a complete rookie can execute. Let's get straight to the conclusion. The pound sterling to US dollar is in a bullish daily trend but is currently fighting a fierce intraday battle at a structural supply zone between 1.3600 and 1.3632. The multi-timeframe dance reveals this. The 1-hour chart is overextended and printing bearish divergence on momentum oscillators, while the daily chart refuses to bend, holding above all major moving averages. The line in the sand, the point that separates bull from bear for the next 48 hours, is 1.3530. As long as cable trades above 1.3530, the bulls have the right to attempt another leg higher toward 1.3650 and 1.3720. A clean 1-hour close below 1.3530, however, neutralizes the immediate bullish bias and opens the trapdoor toward 1.3420, which aligns with the daily MA50 and MA200 cluster. Now, let's get into the deep technical framework. Pull up your charts. On the 1-hour time frame, price is currently at 1.35809, sitting just above the exponential moving averages, the short-term pulse of the market. The MA5 sits at 1.35622, the MA10 at 1.35475, and the MA20 at 1.35311. Notice the slope. All three are angled higher and perfectly stacked. That is textbook short-term bullish momentum. But here's the catch. Price has already kissed the upper Bollinger Band equivalent and retreated, printing a sharp rejection candle from 1.36320 down to 1.35686. That's a 64 pip wick, which tells you there is an institutional sell wall sitting in that zone. And if you look at the RSI, 6, on the 1 hour, it's reading 60.28, not overbought, but it's losing slope. The CCI, 14, is at 123.65, also dipping. This is the first whisper of exhaustion. Now, watch this. The MACD on the 1 hour is currently reading 0.00059, essentially flat, but the histogram bars are contracting. We saw a similar pattern 2 days ago before a 70 pip drop. The signal line is hovering just below the MACD line, and if it crosses negative on this timeframe with price below the 1.3560 pivot, the intraday reversal gets a green light. But let's not trade in isolation. Zoom out. On the 4-hour chart, the moving averages paint a slightly different face. The MA50 on the 4-hour is at 1.34154, the MA80 at 1.34799, and both are still flat to slightly bearish in slope. Price is above them, but the separation is wide, nearly 170 pips above the 50-period average. In mean reversion terms, the rubber band is stretched. The 4-hour MACD is positive with a reading around 0.00270, yet the histogram is printing lower highs against a higher price, which is exactly the definition of bearish divergence. This is not a signal to blindly short. It is a warning that the current grind higher lacks fresh energy. The average true range is compressing, and when you see compression after a 200 pip rally from the 1.3350 region, it often precedes a violent expansion. So, the next 100 pips are likely to be explosive, in either direction. Now we pull up the daily chart, the judge. And this is where the bullish case gets its spine. The daily candles show a clear break above the previous swing high at 1.3400. We have a sequence of higher highs and higher lows since late March. The MA20 on the daily is at 1.34686. The MA60 at 1.33173, and the MA200 at 1.34166. Price is comfortably above all three anchors. The MA20 has crossed above the MA60 a few sessions ago. That's a mini golden cross. The MACD on the daily is also confirming. The difference is at 0.02382, the DEA at 0.00535, and the histogram stands at a positive 0.01847. The line is widening away from the signal line, which means momentum on the daily is actually accelerating. This is why calling a top simply because the 1 hour looks tired is a dangerous game. The trend of higher timeframes always eats the reversals of lower timeframes for breakfast. Support and resistance for the session are crystal clear. Immediate intraday support sits at 1.35622, which is the hourly MA5, followed by 1.35475, the MA10. Below that, the psychological and structural floor is 1.3530, the convergence of the 1 hour MA20 and a previous breakout point. On the daily chart, the first real demand zone is 1.3500, then 1.34686. The pivotal level that changes the trend on the daily would be a close below 1.34150, where the MA50 and MA200 huddle together. That would be a trend-ending signal. On the resistance side, the intraday cap is 1.3632, the high that just got denied. Above that, the next supply area is 1.3650, the March 2026 swing high, and then 1.3720, which is the top of a weekly channel. Any daily close above 1.3650 would ignite a stop run that could reach 1.3800 within a fortnight. Now, fundamentals. What's the engine under this move? Over the past 24 hours, the UK calendar has been thin, but the repricing of Bank of England rate expectations is the invisible hand. The market has pushed back the timing of the next BoE cut after the latest services PMI surprised slightly to the upside. Meanwhile, the US dollar index is wobbling near 101.50, digesting a softer-than-expected ADP employment print. The divergence, a marginally more hawkish BoE against a Fed that is still fully pricing 2 cuts this year, is giving sterling a yield advantage on the short end of the curve. The 2-year gilt yield has risen 6 basis points relative to the 2-year Treasury yield, and that spread is directly lifting pound sterling to US dollar. However, the net speculative long positioning according to the latest COT report is already stretched, longs, and near a 3-year high. When everyone is already long, the fuel for further upside requires a constant stream of positive surprises. And that's exactly the fragility now, the crucial linkage. Euro to US dollar and pound sterling to US dollar are deeply bound as the 2 main anti-dollar pairs. Right now, Euro to US dollar is struggling to hold 1.0700, capped by its own MA200 on the daily. That relative underperformance is a subtle headwind for cable. When the euro fails to participate in dollar weakness, it often signals that the move is more about UK-specific flow than a broad dollar sell-off, and such moves tend to be sharp but short-lived. Additionally, watch the US dollar to Japanese yen and Nike 225 complex. If risk appetite fades and Nike rolls over, the dollar could snap back on safe haven flows, immediately pressuring sterling. Gold and crude have been quiet, suggesting the geopolitical premium is easing. That slightly reduces demand for the dollar as a haven, but it also means the inflation hedge bid in commodities isn't spilling over into currency markets. Bitcoin's correlation with the S&P 500 has risen to 0.72 this week, and if equities correct, a risk-off wave would hit cable indirectly through the yield channel. All these threads are woven. You must watch the tapestry, not the single thread. For the next 1 to 2 weeks, my directional bias is cautiously bullish on pound sterling to US dollar as long as 1.34150 is not violated on a closing basis on the daily. I expect a grind toward 1.3720, but the journey will be choppy because the market is overpositioned. The primary risk that would invalidate this outlook is a hotter-than-expected US CPI print or a sudden hawkish shift from a Fed speaker, which would send the dollar ripping and knock cable back into its 1.32001.3400 range. A no-deal Brexit headline could do the same, but that's a low-probability tail risk right now. Alright, let's turn all this analysis into executable trade ideas. I'm going to give you 3 distinct strategies, each tailored to a different risk appetite. And this is the part where most channels stop, but we don't. We go all the way to the entry ticket and the invalidation. So grab a pen. Strategy 1 is the conservative play, designed for the trader who wants high probability and is willing to wait for confirmation. We are looking for a pullback to the support cluster and then a re-entry long. The entry condition is this. We need to see pound sterling to US dollar dip into the 1.3500 to 1.3530 demand zone. But we will not blindly buy the zone. We will wait for a 30-minute bullish engulfing candle or a bullish pin bar that closes back above 1.3530. Once that candle prints, we enter long on the next candle open. Your stop loss goes 15 pips below the low of that reversal candle, or no wider than 1.3470, which gives you roughly a 40 pip risk buffer and sits below the structural pivot. The first take profit target is 1.3630, which is the 24-hour high. That's approximately 100 pips from your entry, delivering a 1 minute and 2.5 seconds risk reward. The second target extends to 1.3690, near the upper channel boundary, for a 1-to-4 ratio. Once price reaches the first target, move your stop to break-even and let the remainder run. The invalidation condition is simple. If the 1-hour candle closes below 1.3460 before we get our entry signal, the pullback has gone too deep and the setup is void. Move on. Strategy 2 is the standard risk-reward setup, built for the swing trader who understands structure and wants a better entry price without chasing. This trade is a breakout confirmation play above 1.3632. Many amateurs will try to buy the breakout instantly. We will not. We wait for the breakout candle to close on the 4-hour chart above 1.3632. Then we wait for a retest of the 1.3620 to 1.3630 region. The market almost always revisits a broken level. It's a liquidity refill move. Once we see a 15-minute bullish hammer or a bullish divergence on the MACD during that retest, we go long. Entry will be around 1.3620. Stop loss is placed at 1.3575, just below the 4-hour MA10, risking 45 pips. Your first target is 1.3720, a round number and previous weekly resistance, offering a 1-to-2 ratio. The second target is 1.3800, the top of the weekly Bollinger Band, pushing the ratio to 1-to-4. When price reaches 1.3720, close 50% of the position and drag the stop to 1.3660, locking in profit while still giving the trade room to breathe. If the breakout candle fails, meaning a 4-hour close back below 1.3600, the trade is invalid, and we stand aside. Now, strategy 3 is for the aggressive, battle-tested trader who can read 1-minute order flow and isn't afraid of catching a falling knife with surgical gloves. This is a counter-trend short within the resistance zone, and I want to be crystal clear. It carries elevated risk and is only suitable for those who already have strict risk management habits. The idea is a fade of the 1.3625 to 1.3635 zone. We've already seen sellers absorb buying pressure there. We will wait for a 5-minute bearish engulfing pattern that closes below 1.3590, or a 15-minute shooting star. Enter short at 1.3615 with a tight stop at 1.3645. That's just 30 pips risk. The first profit target is 1.3540, the hourly MA10, for a quick 1 minute and 2.5 second scalp. The second target is 1.3500, the psychological magnet, stretching the ratio to nearly 1-to-4. If price rips through 1.3650 on a 30-minute close, the trade is done. Take the small loss and don't revenge trade. Again, this is high risk, high speed, so size down accordingly. Only you can decide if it fits your playbook. Let's lock in the risk management rules that keep us alive. Number 1. Never risk more than 1-to 2% of your total trading capital on any single position. That means if you have a $10,000 account, your max loss on strategy 1 is $100 to $200. Respect that absolutely. Number 2. No open positions 10 minutes before a high-impact news event, UK GDP, US CPI, or a central bank speaker that could spike volatility. Number 3. A stop loss is a sacred contract. Do not widen it. Do not remove it. If the market hits your invalidation point, walk away and reassess with a cold head. The market will be there tomorrow. Your capital must be too. All right, we've covered the terrain. To crystallize, pound sterling to US dollar is locked in a bullish daily structure but under short-term pressure after a clean rejection from the 1.3632 supply zone. The multi-timeframe picture demands we respect the pullback, but the real money will be made by buying into the 1.35001.3530 support with confirmation, or by nailing the breakout above 1.3632 on a retest. The fundamental fuel, the BoE Fed policy gap, remains supportive, but the overstretched positioning is the silent alarm bell. Tomorrow, markets will digest the US weekly jobless claims and any fresh commentary from the Fed's wallah. That could be the catalyst that snaps the range one way or another, so keep your radar locked. Now I want to hear from you. Are you a buyer of this dip or are you fading this rally? Drop your personal pound sterling to US dollar battle line in the comments. Tell me the exact level that would flip you from bull to bear or bear to bull. I read every single one, and the best calls get pinned. If you found value in this breakdown, smash that like button, subscribe, and ring the bell because we do this for all 8 core assets daily. Today, I will also be releasing in-depth videos on Euro to US dollar to Japanese yen with a Nike link, gold, crude oil, Bitcoin, and the S&P 500. So if you're a multi-asset trader, you need to be subscribed. Trade smart, manage your risk, and I'll see you in the next one. This is Alpha Market Meridian, signing off.